Floor is yours.
Thank you so much. So thank you, Ayang and Stephen, for offering the moderating position to me. The ADP, that would be redundant, P is the project. Accounting Design Project is a really wonderful series that connects us to researchers all over the globe. So very excited to be here today. Today we're going to hear Andy Schmidt from North Carolina State present some co-authored work with Nathan Goldman and Christina Llewellyn about DTA VAs. So a lot of acronym soup here. So deferred tax asset valuation allowances. Let me get through just a couple of the administrative things. Andy's going to have the first 5 minutes to go through whatever he wants to go through uninterrupted. And then we can start to chime in either by raising our virtual hands or our physical hands, whatever you prefer, dropping comments in the chat, and we will go from there. Andy, the floor is yours, and we can see your slides.
All right. Thanks so much, Allison. Thank you, Ayang and Stephen, for creating this great series where we can come and talk about accounting design. So I've been on the other side, been in the audience for quite a number of these, and I've just found them. I've really enjoyed them. So it's really been a great thing that y'all have done here. So and I'm excited to actually be able to present something. And so today I want to talk a little bit about the deferred tax asset valuation allowance, and specifically how managers use objective and subjective evidence when coming up with estimates of the valuation allowance. And so really the overall, broad objective here is really just trying to get a better understanding of how managers use GAAP to set the valuation allowance. I sat in on a presentation a few years back by Catherine Drake, who her paper suggested that deferred tax asset valuation allowance adjustments accounted for the majority of the 25-year downward trend in domestic corporate effective tax rates. And I thought to myself, boy, we really just don't know anything about the valuation allowance. Back when FAS 109 was initially enacted in 1992, there were a handful of studies that looked at the determinants of the valuation allowance. But those studies used very small samples, and they only used, and the samples were for only a couple of years around the enactment of FAS 109. And so, since then, there's just been a complete revolution in corporate tax planning, or tax evasion, if you want to characterize it that way, as well as the financial reporting environment for income taxes. So we've had major changes to the accounting for income taxes standards, right, through FIN 48. And we have a big tax disclosure project that's underway by the FASB. There have been big changes in IRS schedules. So, we're just in a completely different environment. And, Graham Rady and Shackelford, and, review paper they had about 10 years ago, really challenged the external validity of a lot of these early deferred tax studies, and said that, it's not clear what we can really infer from these results, given, the small sample sizes, and, well, just kind of the limited samples overall. And so, kind of just go through some of the, results that we find, and then we'll just jump into, background and, our research design, things like that. So, so managers can use both positive and negative evidence in determining the valuation allowance. So positive evidence, is really evidence of future taxable income that could be used to reduce the valuation allowance. And negative evidence is basically evidence that says that we are not going to recognize future taxable income, and so we might need to apply a valuation allowance. And so we, one of the big findings here is that cumulative losses are the most important source of evidence when evaluating the realizability of deferred tax assets. And cumulative losses have been completely ignored in prior research on valuation allowances. And so finding that the cumulative losses are the most important source of evidence, we think is pretty important. We also find that managers can generally discriminate between objective and subjective positive evidence when determining the valuation allowance, but we find that managers will overweight more subjective sources of positive evidence relative to objective sources. Okay? When we look at the consequences of using subjective and objective evidence, we document a positive association between the use of subjectivity in assessing the valuation allowance and the probability of an adverse tax financial reporting quality, right? So having a tax-related restatement, tax-related internal control weakness, and valuation allowance-related SEC comment letter. And we find that firms with income decreasing adjustments, which are positive values of subjectivity, largely account for this positive association between financial reporting quality and the use of subjectivity. And so this suggests that firms are using subjectivity to build reserves in the valuation allowance, more so than for income, any kind of income increasing earnings management. And then we have some additional tests of our two hypotheses. First, FIN 48 created a potential additional source of evidence for the valuation allowance, uncertain tax benefits. And so we document a positive association between the UTB and the valuation allowance, suggesting that managers view the UTB as negative evidence. And the size of the coefficient on the UTB suggests that the UTB represents more subjective than objective evidence. And then we also look at the effects of positive evidence and observations with and without cumulative losses. And we tend to find that in observations with cumulative losses, managers tend to, again, to overweight subjective information in determining the valuation allowance. And then finally, is kind of a cross-sectional test for our consequences analysis. We find that the positive association between subjectivity and financial reporting quality tends to cluster in multinational observations and observations with low analyst following. And this is consistent with the idea that subjectivity is more detrimental when managers have more opportunities to use judgment and discretion in the accrual setting process. Okay. And finally, contributions. I think kind of a big contribution of the paper, and one that specifically kind of speaks to, the accounting, excuse me, guys.
Andy, while you're getting a sip, Alina has her hand raised. So if you want to get through contributions, or if you want to get her question now, I'll leave that up to you.
Sure, go ahead, Alina.
Oh, thanks. Thanks, Andrew. So if you'll get to that, feel free to punt it. And also it's not an area I'm familiar with, but it's you mentioned that. So you see that the managers can, I think the word that you used was discriminate between subjective and objective. So are you saying that they accurately identify, like, so I look at two pieces of evidence and I know that one is objective and one is subjective? Kind of what does discriminate mean? And does everyone agree, would individuals looking at two pieces of evidence, are they supposed to agree that this one is subjective and this one is objective piece of evidence, or is there some gray area here?
Yeah, maybe discriminate is maybe not the best word. We just find that, in our determinants regressions, that the items that we think are more, in general, the items that we think are more objective have larger coefficients in the regressions, larger adjusted R squares relative to, the more subjective items. And so it's not that we, find that different managers are agreeing per se on what's objective versus subjective evidence. That's kind of the whole notion behind this, a consensus-based notion of verifiability, right? That, different people can look at specific items and come to an agreement on them. So does that kind of answer your question?
I'll think about that. I'll wait for you to get through.
Okay. Ayang, do you have a question?
Yeah, so Andy, I have a question about cumulative loss. Whether like restructuring charges or goodwill or other asset impairments are included in those cumulative losses. Because in other stream of the literature, in the impairment or special item literature, seem to suggest that managers somehow has a little bit of degree of freedom in terms of the timing of the charges. And are those kind of like special item included in the accumulated losses? I understand it's all relative. Those are still more objective relative to your other subjective determinants you have in the paper. I just want to clarify whether those items are included in the cumulative losses.
Yes, they are. So
okay.
Cumulative loss is basically, in determining a cumulative loss, you're supposed to include basically everything in pre-tax, everything that would be included in pre-tax comprehensive income, including any kind of one-time charges, things like that. So both recurring and non-recurring items are part of that determination.
And one follow-up, you mentioned other comprehensive income, so even unrealized gains and losses are also included? Okay, thank you.
Andy, can you give any insight into why the cumulative loss piece of the ASC guidance is about pre-tax numbers, whereas the other sources of evidence are all based on taxable income? That seems like a big disconnect that doesn't seem to make sense to me when we're talking about a deferred tax asset being utilized in the future.
Well, I guess say pre-tax numbers, but it's comprehensive income, kind of adjusted for any kind of permanent differences.
But there's still temporary timing differences that are going to matter with respect to whether you can use that DTA or not in the future, right?
Yes. Yeah.
And so when you're talking about the positive versus negative sources of evidence, the positive evidence seems to be all thinking about future taxable income and those 4 different types.
Right.
But all about taxable income. But then given especially because of what you find, given the importance of the cumulative loss and explaining the valuation allowance balance, it seems very odd that there's asymmetry there in what you should be looking at to book the number. No, it makes sense. Maybe it does not make sense to me. It seems inconsistent. It seems just asymmetric, and I don't get the asymmetry there.
Yeah, I guess I'm with you. I really didn't think about it that much in that way, Allison, to tell you the truth. So I think they're just looking at, in general, financial statement losses, right? The cumulative losses. So yeah, I didn't make much of a distinction between I guess didn't think about it in that way, but that's a good point. So, all right. Okay, to get back to contributions, like I said, so I think a big contribution here is we provide evidence on the importance of a evidence-based notion of verifiability, which has long been abandoned by the FASB in the conceptual framework by a more consensus-based notion. And really, verifiability has been downgraded significantly within the conceptual framework, right? In the first conceptual framework, verifiability was a qualitative characteristic of reliability, right? And so in the new conceptual framework, reliability has been completely replaced with representational faithfulness, and verifiability has kind of been downgraded, so to speak, to an enhancing characteristic of accounting information. And so I think our finding that the information content of objectively verifiable evidence is greater than that of subjectively verifiable evidence suggests there's room in the standard setting process for enhancing the role of more evidence-based verifiability. And then a number of studies provide links between the valuation allowance and poor financial reporting quality, through earnings management. And so, our finding that managers overweight subjective evidence when assessing the valuation allowance, especially in observations with cumulative losses, suggests a specific mechanism that managers might use to manage earnings via the tax accounts. Okay. And then one last contribution, we extensively review practitioner guidance and GAAP to come up with our measures of positive and negative evidence. So we really try to have big practitioner-oriented flavor to the paper. So
Hi, Andy.
sure.
So I want to go back to the debate you talk about. That's kind of like a FASB downplayed this verifiability or reliability. I remember the debate is about this trade-off: is that how timely or relevant the information firms can provide versus how reliable or verifiable. And it seems that the paper right now only kind of examine the reliability part, that you have the financial reporting quality captured by restatements, common letter, etc. Have you thought about kind of like testing the other part of the argument, that's whether the information become more or less timely, so like some sort of the tax variable regressing with or correlates with stock returns to kind of assess the other side of the argument, the other information attribute can be a trade-off with the reliability. Yeah.
We really haven't talked much about that, to tell you the truth, Ayaan. So I kind of thought this is more of a reliability oriented study. Trying to provide more evidence on the importance of reliability, especially given that it's been, like I said, it's kind of been pushed aside somewhat in the conceptual framework. So at least that was kind of approach I thought we were taking. So, but we could definitely think about, adding a, reliability. I mean, excuse me, a relevance-oriented test. So I'd have to think about that. Okay. All right. So back to a little bit of background here for the valuation allowance and deferred tax assets. Right, managers recognize a deferred tax asset for any deductible temporary differences in operating loss and tax credit carry forwards, and measure the deferred tax asset using enacted tax rate and provisions of the tax law. And so managers must recognize a valuation allowance if it's going to be more likely than not the company will not realize all or some portion of the deferred tax asset. Right, so the valuation allowance basically is a mechanism to write down the value of a deferred tax asset if we don't believe we're going to be able to, have enough taxable income in the future to utilize those deferred tax assets. Okay, and managers must assess all available evidence, both positive and negative, to determine the amount of any valuation allowance. And so, like I said before, positive evidence is evidence that the firm will have future taxable income sufficient in amount and character to realize currently accrued deferred tax assets. And negative evidence is evidence that the firm may not realize any currently accrued deferred tax asset in the future. Right, and the more negative evidence that exists, the more positive evidence is necessary to come to a conclusion that we don't need a valuation allowance for, some or all of the deferred tax asset. Okay, in terms of negative evidence, really our gap and practitioner guidance suggests that the presence of recent losses is the most significant piece of negative evidence. In GAP, they say forming a conclusion that a valuation allowance is not needed is difficult when there is negative evidence, such as cumulative losses in recent years. And like mentioned before, the FASB generally determines the presence of a cumulative loss based on the sum of pre-tax book income for the current and prior 2 years. Okay, and again, just losses really are thought to be the most significant source of negative evidence. And then GAP.
I had a quick question regarding wording with the positive evidence and the negative evidence. That's part of ASC 740.
That's correct.
Right.
Yes.
So stepping back from this being a tax account, the concept of an asset and then reserving against the asset is very familiar for anyone who teaches financial reporting or familiar or to accountants. And so I wonder if you could make the paper a little bit more accessible to non-tax people by kind of framing it in that way. This is just any other type of asset allowance account. It just has a lot more subjectivity than like an inventory reserve or something like that. Okay. And then it's even, so Young, I see you nodding your head. Would that help for we were talking in the hallway about what is the DTA VA? And I've been working on inventory right now for my students, and it's just like an inventory reserve was how I was talking about. You've got an asset, you don't think you're going to use it all, so you book an allowance against it. And it can go up or down based on how facts and circumstances change. But there's a lot more technicality because you have to kind of project further into the future and more subjectivity with this other system. So I think there's a place in the paper where you could make the concept very accessible to people that might not be thinking about DTAs and DTLs all the time.
That's a great suggestion, Allison. And another good comparison would be the allowance for doubtful accounts.
Mm-hmm. Exactly.
A lot more familiar to students than are,
Exactly. We're all familiar with these asset reserve accounts and how they can go up or down. But then I think that actually offers you a transition into like the guidance here is really technical. We've got these things about positive and negative. And I know that's the language used in ASC 740, but I wonder if you could frame it a little bit differently. Like it's like evidence that the DTA needs to be reserved against is negative, and evidence that you don't need a VA is positive. And it's a little bit of wordsmithing, but I think it might make it a little bit more accessible to non, accounting for income tax people. I guess that's the best way to say it.
yeah. Yeah, excellent. Definitely we can do that. That's a great suggestion. Okay. All right, well then, back to the positive evidence, which would be evidence that we need to remove the reserve, right? And so there's 4 sources of positive evidence outlined in ASC 740. So the first source, and these are kind of listed in order of objectivity, or at least perceived or proposed objectivity. So the first is taxable income in prior carryback years, if carrybacks are allowed. And then future reversals of existing taxable temporary differences, right? So you can offset your gross deferred tax assets against deferred tax liabilities. And then tax planning strategies. And then finally, future taxable income exclusive of any reversing temporary differences and carry forwards. Okay, and so figure 1 kind of summarizes up the positive and negative evidence, as well as what are thought to be more objective versus subjective sources of evidence, right? So cumulative losses being the most the most objective. And then for the positive evidence, you have carrybacks, temporary difference reversals as being objective, and then tax planning strategies and future taxable income as subjective evidence. Okay. All right, so then we'll jump into the hypothesis. And so the first hypothesis is really about the relative verifiability of the sources of evidence. Okay, and so, right, GAAP states that managers should use judgment in considering the relative impact of positive and negative evidence and give less weight to more subjective evidence. Okay, or excuse me, to more subjective estimates. Right, and so in general, the standard kind of and the guidance state that objectively verifiable evidence consists more of current and historical results, and subjectively verifiable evidence kind of consists more of projections and forecasts. And so like I said, there's this perception of items that are more objective versus subjective. Cumulative losses supposed to be very objective, right? As well as carrybacks and reversals of temporary differences. And then tax planning strategies and future taxable income, more subjective sources. And so our first hypothesis then is that the association between the valuation allowance and objectively verifiable sources of evidence is stronger than the association between the valuation allowance and more subjectively verifiable sources of evidence. Okay. And then our second hypothesis really deals with the consequences of using subjective evidence, right? So the guidance emphasizes the importance of using objectively verifiable evidence, as there's really inherent benefits for external financial statement users when managers rely more on objective versus subjective evidence. right? So, research has shown that subjective evidence requires, more estimation, which can lead to less reliable accruals, more discretionary accruals, and greater capital market distortions. Subjective evidence is often difficult to audit, can lower the reliability of financial statements and lead to restatements, right? And, intentional and unintentional estimation errors related to the tax expense decreases the quality of the tax accrual and leads to increases in adverse tax related financial reporting outcomes. And so, our second hypothesis is that there's, positive association between the firm-specific use of subjective evidence in determining the valuation allowance and the likelihood that the firm has tax-related financial reporting, misstatement, an internal control weakness, or a valuation allowance related SEC comment letter. Okay.
Andy Sudita has his hand up.
Sure.
Go ahead, Sudita.
So you sort of portray earnings as being objective, but there are a lot of subjective choices, as you just discussed with the accruals. So in fact, the accruals by definition almost have to include subjective forecasts of future cash flows. So I'm not sure how or why you think of that as more objective, because ultimately those forecasts of the future cash flows are flowing into the income.
So I'm not sure exactly. I mean, when you say that, like, I think of earnings as being more objective, I'm not sure if I'm understanding your comment correctly.
So, for example, think about earnings management.
Yes.
Right? So the number that's reported is not objective, it's subjective because it was manipulated by managers. Yet you're saying somehow that it is subjective. I'm not sure what it means.
Well, I guess, I'm just talking about here objective and subjective in the sense of, the evidence that's being used to establish or, remove a valuation allowance. So not necessarily just characterizing earnings itself as objective or subjective, but rather the, evidence that managers are using to, implement a valuation allowance.
So if you use the analyst forecast, would that make the future forecast objective rather than subjective?
Well, yeah, that's a good question, right? So our analyst forecast of earnings a more objective source of future taxable income, right? Right, because that's the, future taxable income is one of the sources of evidence. And so, and according to the standards, that's really the most subjective source of evidence. And so,
doesn't it depend on who's making the forecast though? I think that there'd be a difference between managers and analysts forecasts.
definitely,
In terms of subjectivity.
yes, definitely. So that's something, we, for our proxy of the estimated future taxable income, we just kind of use a simple, simple autoregressive forecasting equation, whereas we could look into, using analyst forecasts or manager forecasts, as a alternative, proxy for that. So, but I agree there would definitely be differences in objectivity or subjectivity depending on who's doing the forecast.
Sudipta, is your bigger point that it's all subjective and there's just kind of a sliding scale? So we really shouldn't, we should say less subjective and more subjective. We shouldn't use the word objective.
Yeah. Or, I think the degrees of objectivity is correct, because even if you think about accruals as being subjective and cash flows as being objective, I think even that's a false dichotomy, because you can change your classification of cash flows, right? So there's subjectivity on whether it's operating or financing and investing. So there's whole books on this matter. So all I can say is that, there's a range, but nothing, depending on the circumstance, what is on the surface objective can be really subjective.
Yeah, unquestionably. I agree with you 100%. So yeah, it's all relative degrees of objectivity or subjectivity. No doubt. Okay. All right. So moving on here to the research design. So we basically collect valuation related data of S&P 500 and S&P 600 firms from audit analytics, XBRL filings, and SEC Form 10K, and merge this with data from CompuStat and CRISP. So our final data set includes about 7,000 observations for the year 2008 through 2017. We exclude observations with the 2017 fiscal year end that ends after December 22nd, 2017. And that was the date that the Tax Cuts and Job Act of 2017 was signed into law, right? We had a reduction of the statutory rate there. And so, observations had to revalue their deferred tax assets and deferred tax liabilities based on that new federal statutory rate. And so we just want to have consistent, relatively consistent, tax reporting regime during our sample. We windsorize all our non-indicator variables annually at the 1st and 99th percentile. And all of the deferred tax data that we use in the study comes from the DTA or DTL disclosure in the tax footnotes found in the 10K. And all of our deferred tax data articulate according to the formulas here, right? Gross deferred tax assets minus the valuation allowance equals net deferred tax assets. And then net deferred tax assets minus gross deferred tax liabilities gives you your net deferred tax asset or deferred tax liability. And so, we get all this from the XBRL data, and there were just significant articulation errors in the data. I would say only about 35% of the data that we were working with actually, articulated according to these equations, when we first examined them. And then the rest of that, I had to make adjustments to the data and cleaning it to get the data to articulate. So just looking at some descriptions of this data, our gross deferred tax assets are on average about 7% of assets. The valuation allowance on average is about 17% of the gross deferred tax assets. And gross deferred tax liabilities are 6.4% of assets. And on average, firms are slightly in a net deferred tax liability position. The mean of negative 0.14. So the median is actually about 0 for that. So, right, so what have you.
Andy, I had a quick question regarding the sample composition.
Sure.
There's a some discussion in the paper about how these earlier studies had very small samples, very short time series. And so you're able to provide this 10-year time series. And so a perfectly balanced panel, if my math is right, you've got 1,100 observations over 10 years. So you would have 11,000 firm years, but you end up with only about 63% of that balanced panel. Now that's in a perfect world. We all know when we hand collect data, it will never be perfectly balanced. Can you explain, why, over 35% of the sample, potential sample was lost? Is it because firms fell out of the S&P 500 or 600? Are you kind of rebalancing every period? I was just really curious as to try to understand what was going on there.
Oh, no, I'm sorry. We didn't lose 35% of the sample. What I was saying was that when I was trying to collect the XBRL data, only right after downloading that data, only like 35% of it actually articulated like you expected it to articulate. Otherwise, there were lots of XBRL coding errors in the data, and it took a significant amount of time to clean those up. But all of the what I like to say, the non-articulating observations, they're all still in the sample. I just had to clean that data up to make it usable.
I think my 35 and your 35% were just a coincidence. I was talking about for a balanced panel of 1,100 firms over 10 years. In a perfect world, you would get 11,000 firm year observations. And so I was trying to figure out, well, usually there's some sort of table that walks us through, we lost because of these reasons. And so are firms dying? Are they dropping out? The reason I bring this up is because I'm thinking of all of the ETR papers that show that when we throw out, T-1 or T+4 for a firm, when we calculate this ETR, we're getting a very kind of distorted view of the world. Now, your paper's not about ETRs. I'm not trying to say it is. I'm just trying to understand, the missing chunk of observations, how that might affect what we learn from the stylized descriptives and then the regression results. Does that make sense?
Sure, fair enough. I wasn't going for having a balanced sample. I mean, this is the downloaded data, and then we lost a lot of data, obviously, due to matching up with CompuStat and CRISP. And so I guess we probably need to go back and put together a sample selection table to kind of get a better understanding of where that data is missing. So definitely. Okay. All right, so talk real quickly about the positive and negative evidence variables that we're going to use in the study. Like I said, we extensively reviewed practitioner guidance produced by tax specialists at Big Four accounting firms to develop our proxies of positive and negative evidence. And so for taxable income and carryback years, it's just an indicator variable equal to 1 if the 2-year average of estimated taxable income from years T-1 and T-2 is positive. And so we estimate taxable income consistent with how it's done in the tax literature, right, by grossing up federal and foreign tax expense and then subtracting the change in tax loss carry forwards. Then future reversals, just an indicator variable equals to 1 if the ratio of gross deferred tax liabilities to gross deferred tax assets is greater than 1. So our tax planning activities, this is probably a little bit different than what most people would expect. At least most tax folks would expect as a measure of tax planning activities. It's the industry year adjusted difference between the market value of equity and the estimated tax basis of net assets. And this measure really reflects opportunities to generate taxable income by selling appreciated assets outside of the normal or ordinary course of business. Okay, so initially when we thought about measurement for tax planning activities, we thought of using some kind of, ETR-based measure, which is consistent with, with the tax literature, but the, but the practitioner guidance says that, really tax planning activities aren't anything that a company would do in the ordinary course of business. So, really, the measurement of this, was more geared towards, selling appreciated assets in order to, generate taxable income. So, so that's the kind of way we went with that, with the, measuring tax planning. Okay, and then, like I said before, our proxy for future taxable income is just a simple forecasting regression of estimated taxable income excluding carry forwards. And then finally, our cumulative loss is an indicator variable that equals 1 if the sum of basically pre-tax comprehensive income for the years, for the current and the prior 2 years is negative. Okay.
Hi, Andy. I want to go back to those measures, and I have 2 questions. The first one is that I'm not familiar with the text literature, but like, would the paper's kind of like contribution is introducing some of those new measures to that literature, or are those all established in the literature already?
So I think that like the reversal variable has been pretty common in the prior DTA literature, and in the past, like for future taxable income, they tend to use things like ROA, as evidence of that. So so really, I think the tax reversals and the carrybacks are probably the only measures that have been used in prior literature, and then the other ones are relatively new. So
okay. And my second question is, I think going back to earlier discussion, as Deepta kind of pointed out about which line item or which variable is actually more subjective relative to others, it seems that the way you construct those variables, your objectivity versus subjectivity really depending on the timing of recognition. So your objective variables are the recognized numbers from T-2, historical kind of recognized numbers, and then your subjective numbers are the numbers not yet recognized in the financial statement. Is that the correct kind of like articulation about how you think about objectivity? Is the numbers already printed in the historical financial statements versus will happen in the future?
yes, yep, very definitely.
Okay, all right, thank you.
We can go back and like, for carrybacks, we can go back and look at prior tax returns, right?
Yeah, I think clarifying that will really helpful, because historically recognized numbers can also involve subjective judgments. For example, allowance for doubtful accounts or allowance for inventories, but those has been recognized so that you assume that has gone through more internal and external scrutiny. So that number relatively is more objective or less subjective compared to a number that had not yet been recognized.
Yeah.
Yeah.
Definitely.
Thank you.
Yep.
So if I can jump in here for a second, the current crisis with Silicon Valley Bank and others is about, the reporting for held to maturity securities, right? And they're recorded at cost, which was objective. But the argument is that they're unrepresentative of current values. So we have an objective measure, let's say, of what those securities are worth based on the market price. So now, does it make sense to characterize old historical cost numbers as objective and current market price is subjective? This is a different way of asking Ayung's question about past versus future. But, I mean, what happens when historical cost information is out of date, say because of high inflation? Or conversely, if we are in a bubble and the market price is unreliable? I'm just having difficulty with this whole subjective versus objective notion. I mean, I understand it's in the standards or it's in the internal review code, but that's separate from how I would think about objectivity and subjective.
Gotcha. Okay. I mean, yeah, obviously, I mean, objective numbers can, definitely have less information content based on, different situations, right? And so, that would, obviously make them, weaker in those situations, right? So, definitely point taken.
Okay, I agree on that. And one more thing, your future TI, you've assumed a linear regression, but there's tons of evidence that these sort of relationships are non-linear asymmetric. You can go back to Carla Hayne in 95,
Yep.
and even earlier, I think, Brooks and Buckmaster in 1976.
Sure.
So there's lots of evidence that this relation is not linear. And so how would that affect your inferences if you've got a misspecified model?
Yeah, so yeah, that's a good question. We were just trying to kind of come up with a very simple model of an estimate of the future taxable income. And obviously, if it's this is not going to be the right model necessarily the way that managers do this in real life. We're just trying to come up with kind of a simple proxy here. And so if it's not, then I guess we bias our coefficients down down to zero. I guess make it look probably more subjective than it really is, right?
Well, this bias down towards zero only works if it's a simple regression. As soon as you go in multiple regressions, none of that intuition works. It could be biasing your coefficients up or away from zero.
Sure.
Because of correlations between errors and stuff.
One thing we're doing right now, and we're trying to revise the paper, and we're trying to look at different proxies for future taxable incomes. Like you mentioned before, maybe look at analyst forecasts or managerial forecasts, things like that. So, okay, because there's no doubt error in our estimate here.
And do you have a question from Oliver?
Sure.
Andy, just a suggestion here. I mean, I think like kind of what you want to hold constant is kind of this fundamental income, right? So, I mean, maybe rather than just using forecasts here, have you guys thought about using kind of differences in forecasts? So if you compare the management forecast to the analyst forecast, and then kind of like take this, like the difference as kind of more like as a closer measure of the subjectivity. I mean, it could also be private information that is just relevant here, but I mean, rather than trying to just say, look, I mean, like this whole thing is kind of subjectivity. I mean, there at least you kind of try to hold to some extent kind of like the underlying fundamental constant, right? Yeah.
We honestly hadn't thought about that, but that's a great suggestion. So we'll definitely take a look at that.
Also, Sharon has a question. Go ahead.
I just want to follow up on the management forecast question. So I actually did this analysis comparing management forecast and valuation allowance in my dissertation. And definitely the valuation allowance can predict much longer horizon compared to management forecast. So I think this is something definitely easy to do, but also kind of like in terms of framing the paper, essentially the valuation allowance is kind of like earnings, like a second earnings forecast, but this is more verifiable than management forecast. So both management forecast and of course the valuation allowance are subjectives, but if we compare between these two, actually auditors verify the valuation allowance while they are not going to verify management forecast. So maybe this is something you can use to frame and address the subjectivity of the valuation allowance.
Okay, that's a good suggestion. Thanks a lot.
Andy, you have 4 minutes left to continue your presentation.
Gee, okay. I don't know what. Let's see if I can try to get to some results real quick. Like, and how about that? Right. So here's I guess the results of H1, the relative verifiability of the valuation allowance evidence. So basically, we're looking for positive coefficient on cumulative losses and negative coefficients on carrybacks, reversals, tax planning, and future taxable income, which we find. Looking at the size of the coefficients here, right, they're all kind of conform to what we hypothesize. Cumulative losses being the largest coefficient, followed by carrybacks, reversals, and tax planning. But then we look at future taxable income, and we see that's the coefficient on that is is higher than what we would expect. And this is where we kind of come up with saying that a supposedly subjective source of evidence is has a coefficient, like I said, higher than we expect, more like the objective evidence. So kind of suggests that managers are overweighting a subjective source of evidence here. And that gets stronger when we look at cumulative losses. Right. So if we kind of come here and I think this is table 5, panel B, we see that as we move over and look at cumulative losses, reversals become much larger, as well as our subjective sources. And so that's suggestive that when firms have cumulative losses, managers just increasing the weights on the subjective evidence relative to objective evidence. Okay, and then finally looking at the consequences of using subjective evidence. Like I said, we find positive correlations between our measure of subjective evidence and tax restatements, internal control weaknesses, and valuation allowance related comment marks. So I guess we're probably about out of time, right, Allison? So anyway.
1 minute to conclude.
Well, let me just wrap it up by just saying I really appreciate everybody attending, and it was really great to be able to participate, to present the paper here, and to really want to thank you guys for the opportunity.
Andy, do you have the next event slide?
I do.
Thank you.
All right, so the next event, we've got James Popta from American University, and he's going to talk about goodwill impairment after mergers and acquisitions.
Thank you. Thank you, Andy.
Thanks, I.